Good morning, ladies and gentlemen. We are extremely pleased that so many of you actually are willing to join us this morning, because on Friday this week we'll have our second Swiss Value Day, where we actually have already 160 people signed in. So we were really very happy that so many of you that probably cannot make it to the second Swiss Value Day are joining us now for this quarterly update call. We have a lot of topics to discuss, so I would like to jump immediately and pass on to Marcos. Marcos, the floor is yours.
Thank you, Alex. Good morning, everybody. Thanks for joining the call today. I'm going to start directly in the slide number 3 with the question that we ask every quarter: where are we in the cycle? And as we say in the slide, the title is "Who is Swimming Naked?" Basically, we've been in a very long cycle of low interest rates and huge liquidity. This is what Warren Buffett calls a high tide, and now the tide is out, right? So we are seeing the first bodies, the dead bodies, kind of SVB Bank, Signature Bank, First Republic, Credit Suisse. We also saw some dead bodies before, Greensill, the crypto platforms, some UK real estate funds that shut the door last year. And this will be not the last, because, we are now in an economic slowdown and in a kind of normalization phase. In our opinion, so this is not very positive, but we think we are not facing a systemic problem. It's not like in 2008, 2009, where we had really a big bubble in housing in a big part of the economy. Now we see pockets of risk, but we don't see a big concern for the economies or for the stock market. So in terms of where we see risk, commercial real estate, maybe private equity and venture capital, long-term bond portfolios due to the rise in interest rates, leverage credit, SPACs, cryptos, etc. We are not exposed to that, but anyway, from a macro perspective, it's not a big deal, and for us, it's nothing because we are not exposed. In terms of timing, we think we are half the way. So we think that the slowdown started by the end of 2021. We've been there 1 year something, and there's still some quarters to go. So basically, we call it economic slowdown. Over the years, we've learned to live with this situation, and we now like this situation because we will be able to buy on the cheap if the market corrects. If the market does not correct, then we will make our 10%, which is what we target on a year basis. In the slide 4, I wanted to highlight the past 10 years. If you look since 1983, this is a chart that we found on the internet. You can see the cycles that have been named growth cycles and value cycles. And we had a huge growth cycle where growth outperformed value for the past more than 10 years. And this is directly related with the liquidity and with the low rates. So everything has been up in terms of growth and tech, etc. Now it's time to normalize. We think that the value cycle started in 2022, so last year, and we think we're going to have several years of value normalizing and growth normalizing. In terms of where are we from a macro perspective, if we move to slide 5, just brief comments on some charts. So the industrial production growth has turned negative for the first time on a global basis in March. The normal timing suggests that there's another year or so of negative data. Although the marginal data is not bad because Europe has not entered in recession versus the expectation of Europe going to the recession. It is not, which is good news. And also China is starting a new upcycle. So maybe the feared recession or a slowdown is going to be milder than expected. In slide 6, I wanted to highlight inflation. We've been calling inflation going down already for several quarters, and inflation is going down. Even in Spain, yesterday, the data, it's starting with a 3. So inflation is normalizing, and by 2024, we think it will be much more close to 3% than more than that. Just a couple of worries here: labor markets that continue to be tight, and also energy, because that we think that energy prices will move up in the future. On China, slide 7, it's starting to normalize. there's a lot of comment and a lot of, chat about how weak China is. It is not really that weak. First quarter, the GDP up 4%, and the target for this year is around 5%. And, we see property stabilizing, as you can see in the chart, which is the main concern for us and probably for most of the economists. If property stabilizes, then, the government will inject more money in public construction and consumers should be back on track after the COVID. So we are pretty bullish China, although short term is not doing what we expected, but we don't really mind. In slide 8, I want to talk a little bit on US recession. You can see here the US Senior Loan Officer survey, which is a kind of measure of credit. And if you do an historical comparison with the GDP, you can see that credit is being tighter and tighter, and GDP should go to 0, -1%. Okay, that is what everybody expects. The US is slowing, and it's the impact of rates and tightening. So it's a normal cycle. Not really big issues here. So as a conclusion in slide 9, we still track 5 indicators in this cycle, as you know very well. Still 4 of the indicators are negative delta. Rates still up in the US and in Europe. PMIs still down. Earnings moving to downgrades, and liquidity, which is being cut overall, although China has turned positive. So the first indicator that has turned positive is China, and also rates are, close to the peak. So in the end, still kind of somewhat negative, the delta, in terms of where we are in the cycle. Again, 1 year to go, in our opinion, of slowdown, but we don't really care. Our books are really solid. We have good companies, we have good balance sheets, etc. So the only thing we can do is buy cheaper, which is good for us. And a lot of interesting themes. We are finding a lot of interesting themes: energy transition, supply chains, a new capex cycle, scarcity in labor, energy, commodities, digitalization, artificial intelligence, etc. There's a lot of things we can play in the next cycle. So with that, I turn over to Carlos, that is going to probably go deeper in the recession fear. Thank you.
Hello, good morning. Well, in the first slide, number 11, everybody, including Marcos and myself, has been talking about recession for a long time. It makes sense because the market economies have this tendency to cycles. Now, we should never forget, well, first, and I say it every time, but I like saying it, nobody knows what's going to happen. That includes, of course, me, but that includes, of course, you. I mean, nobody knows what is going to happen because the economy is very complicated and every time is actually different. We had never had a pandemic where the whole economy stopped, and then the whole economy was restarted, and then we had no containers or ships, and there were too many containers. This has been very strange, and it is normalizing little by little. But of course, to that you add what Marcos was pointing out, and everybody knows, 16 years of zero interest rates almost, and then now you raise the interest rate sharply. And the truth is that nobody knows. It's like you take 5 aspirins and 3 things and 4 other things, which never has been done before. So, well, once we've said that, let's also take out of the way the idea, there is in behavioral economics, people talk about recency effects. Whatever happened recently, obviously weighs more on our thinking, our feelings, than what happened 10 years ago. Even if what happened 10 years ago is more likely, for some reason, to be repeated than what happened last time. Now, last recession, you have here a table. These are US recessions, but this is not very different throughout the world. Because the US economy really determines much of what happens. If we take away the last line, which is a very weird pandemic thing, the last recession on the table is the one that everybody has in mind when we say recession, not only because it was the last one, but also because it was the longest and deepest. Look at the amount in months, 18 months. And much more important than that, the hit to GDP, which is what really matters. We are actually in recession, so going backwards in wealth. It was by far the largest since World War II, actually. And this is what everybody has in mind. When you think recession, when I think recession, we think 2008. Well, but that is not the norm. In fact, that is a big exception. And of course, we could go on and on why that recession was very unique and not easily repeated. If you look at the table, what you see is that recessions tend to be shorter than a year, and not very deep in general, with this big exception of 2008. Sometimes it's just even less than 1% drop in GDP. And unemployment goes up. Now, unemployment is important because at the end of the day, recession is an abstract concept. I mean, nobody eats GDP. You know? I mean, the GDP goes up 2%, down 1%. So how does it affect us? Now, the way recessions matter is because we can see that in the next slide. Recessions affect because people get out of a job. I mean, they go unemployed. If everybody stayed employed, doing the same things that we're doing before, GDP would not go down. GDP does not go down for some sort of strange miracle. It goes down because some people stop working involuntarily, of course. And that may be because there is an energy shock like in the 70s, or the banks go bankrupt like in 2008. And then companies do not get enough demand for their products. And then if a company does not have enough demand, they have to fire people, I mean, reduce production and reduce cost, fire people. Then if people get fired, they themselves consume less because they have less money. And the other companies have to reduce production. And that is your typical recession. But the key variable at the end of the day is employment. Now, it is important, and we saw that on the previous slide, that the impact on employment is different in different recessions. Now, in this recession that is coming, which will come at some point, because they always do, it's important to realize that we are starting with the lowest unemployment in history since it's been measured. And what matters at the end of the day is not even unemployment, it's employment. How many people are actually working? And more people are working than they have almost forever. So in this sense, even if the economy slows down, it is slowing down already, we start from a very high plateau, which means that if nothing strange happens, production, GDP should not go down too much, which means in the end, what matters to us as citizens, what matters is unemployment. As investors, what matters is profit. Now, if overall GDP stays relatively high, profits will not crater as they did in 2008. So, and what's interesting, you can see in the next slide, and this is a point that is not discussed very much, but it is very, very important when we're talking about the economic impact of recession. We can go to the next slide. This is about employment that you can see is the highest. Is that, and these are data for the US, but it is the same in Europe. Well, not in terms of race, because it's different, but in terms of social structure, it is the lower paid people who are now enjoying a better labor market. And this is probably the first time in 40 years. And this is very important. And we've discussed it sometimes because it doesn't get enough attention in my opinion, is that what economists call the propensity to consumption for poorer people is much higher, obviously. If wealthy people, get a few more €1,000 or francs at the end of the month, they normally save them because they're already spending all they had to spend. But poorer people spend everything they can get. And if they get a little bit more money, they spend it. That's why all the subsidies that were given during the pandemic had a huge impact on GDP because they were immediately spent, as opposed to many other things that do not get spent. So to summarize, this is probably as good a place as any to start a recession, and when it comes. It shouldn't be too deep because employment is very high, and lower paid workers are particularly less bad, if you wish, or better off than in the past. So this should give some resilience to the economy. Something nobody's discussing about, particularly because like yesterday, oil went down 4% in one day. You see these big financial moves. Nobody's talking anymore about that. And one of the big reasons headline inflation is going down, as Marcos just pointed out, it is because energy costs are down. Well, we believe they're going to go up eventually, and not in a very, very long time. And that will be bad news. That will be bad news for inflation. That will be bad news for the economy. But apart from that, and that of course tells you where to position yourself for such a situation. But apart from that, we see not a really bad situation. And many companies should be able to do fairly well throughout this period. Remember, inflation means everything goes up, and everything includes companies' profits. In fact, revisions for profits in current terms are going up for next quarter because inflation goes down to companies' profits also, of course. Okay, these are just a few ideas on the.
Thanks, Carlos. I'm taking back the presentation to go through the two funds and the investment case. So if we start in slide 17, I'm starting with the classic. You know the philosophy, global value, very good last year, up 14%. And this year we are around 4 or 5% year to date. In the first quarter, which is what we show here, we were up 6%. Best sectors, aerospace, defense, cables. Consumer did very well also, technology and cement. And worst sectors, salmon and the new tax, healthcare because of defaults, and energy. Energy is taking a hit with oil prices and gas prices going down. So this is a highlight for the first quarter, and probably for the first half is lower oil prices and lower gas prices that I will speak on later. In the slide 18, you can see this is a slide I like to put in all presentations. This is basically 40% of the classic. So in 10 names, you can have a quick view on where we are invested in. And if you look through these names, you can see that the exposure to a downturn economically will be very, very soft. You know, Heidelberg Materials, cement, prices up, volumes down already last year. Sodexo, there is an outsourcing trend. ISS, there is an outsourcing trend also in cleaning. Grifols is more restructuring stuff, and plasma proteins are growing 8%. Unilever is growing as most of the food guys or consumer guys, thanks to pricing power. Pandora may be a bit weaker short term on lower demand, but if you look through these names, you can see that the resistance to any downturn will be very good. This is basically because we focus on the 4Gs, good business, good management, good balance sheet, and good price. Just two comments here. We reduced the weighting in energy, oil and gas last year on pricing, not because of we didn't really see the price going down. Basically, we decided to lower the weight last year, and we also know that we tend to move into trouble. We don't want to be into trouble, but we end up into trouble because we have Grifols and Unilever that are two restructuring cases, and 4 of these 10 names are also either completing or completed a restructuring. So, you know, this is a relationship between stocks that are cheap and some pain in the short term, but all these businesses are good businesses. We have a strategic analysis and a strategic thesis that tell us that, you know, the restructurings will be completed in the right way. In the next slide, let's go to valuation on the classic. An updated IRR is around 13.6% now. You know that we value all the names. We have a average weighted IRR of 13.6% now, intrinsic value 850 euros. It's a bit depressed because we are managing the portfolio a bit more conservative than usual on the slowdown, on the economic slowdown. So we have some cash. We have more categories 1 and 2. So the book is a bit more defensive than usual. But anyway, the IRR is close to 14%, which is more or less in the middle of the historical range. Historically, and we have already 20 years of data, the classic has moved in an IRR range between 12 and 17. So at 14, we are not expensive, we are not cheap. It's a kind of good level to be in, fair. Our target for 23 is 625 euros. Now I think the last is 580, so we are another 5% to go there. And I want to focus on the long term and put a target which is a round figure. So for 28, in 5 years, we want to reach 1,000 euros per share. And this is a 10% annual return. So it is surprising to be so aggressive in the target, but in the end, it's just, you know, the magic of long-term and compounding returns. In the next slide, you can see what is the actual slide 20 PE. The valuation is low. The PE of the Classic is 10 times, and the MSCI World PE is 15. So as we promised, we buy on the cheap. Dividend yield 3.3%, 1 point more than the index, and price to book 1.6 versus 2.4. So basically, you know that we buy at a discount. Normally, this discount is 30%, and this helps us also to manage the downturns. And just a last message on the Classic in slide 21. So we've done, when we changed and we adapted we changed the strategy a little bit after the global crisis, and we adopted the 4 categories risk strategy, 4 risk categories. We've done 10% since 2011, basically 12 years, 10%. We see no reason how the portfolio is built to change this dynamic in the future. So our target will be 10, 11% in the next few years. Again, we don't pursue alpha. Alpha will be the resulting deduction from the market. The market long-term does 6, 7%, and we think we can do 10. So the alpha will be the consequence. Let's move to slide 23. Investment case of the quarter, Nexans. It's a leading company, leading manufacturer of electric cables and related products and transmission and distribution of electricity. So this stock entered the Classic in the first quarter. We checked just recently, so it's a new stock for the Classic. And you know, on the demand side, the call is very clear. The sector faces one of the strongest growth phases ever in his history because of the energy transition. So we are going to need electric cables and all kinds of devices for the electrification of the world economy. So it is very, very well placed in that aspect. But what really attracts us is the supply side of the sector, because it has been consolidating for the past decade. Now, Prysmian and Nexans, they hold more or less a market share of 30%, even more in some market niches, the more complicated niches. And also they have changed their risk management approach. This business is a risk management business because you have huge contracts. You need really to control pricing, cost, and execution. And these guys have done the homework. So we like it a lot, and we will be buying. If the market goes down, we will buy like hell the 2 names and build a big position here, because we will have years and years of growth. In the next slide, you can see a little bit the valuation. So we like a lot the management as usual. I mean, really the management of Nexans is outstanding. And in terms of valuation, you may say, well, it's not that cheap, PE of 14 times 23. But if you move on a couple of years, in 25, the PE is already 11. We think that, and this is consensus, we think the consensus is too conservative. We think that volumes, prices, margins will be higher. So we expect upgrades in Nexans. Price now is around 75 euros. Our intrinsic value is 125. Our IRR is around 14% on the current price. We think it's an excellent investment. So very happy to say welcome to the Classic. Let's move to the Natural Resources Fund in the slide 26. So yeah, natural resources last year was good also, similar to the Classic, 13% increase last year, and very similar this year also. It's a 6% increase. I would highlight only the weak, again, energy performance, down 6%. And this is due to the lower oil prices and lower gas prices. Agri-food is flat this year, and mining is a bit better, is up a little bit, 6%. Infrastructure is doing well, 17% increase with the cement companies that are being repriced. Just, to repeat a little bit here, what we did is reduce the energy weighting. Last year, by this time, we had more than 50% in oil and gas. Now we have 1/3 of the book here, because we were selling last year. So we were lucky that the oil price is down, and at some moment we will be back buying more oil companies. It's a little bit early, but we will do that. So that is basically the sum up of this year's performance for the natural resources. In slide 27, you can see the look through. Oil is 33%, gas is 5%, copper is 24%. So this is the big difference with last year is 15 points less in oil and probably 10 points more in copper. As we said, we've been buying copper for the last, I don't know, 8-9 months, slowly but surely at the right price. And we will continue to buy copper if copper continues to go down on fears of recession and fears of China, because, our call, I will go in detail now. In terms of, you see in the right, our mantra, again, good businesses, management, balance sheet, and cheap stocks, and looking for scarce commodities, good geographies, near production, no startups, too much risk, no majors, because the marginal dollar is going to the wrong business. So basically, we keep our mantra unchanged. In slide 28, some wording on the valuation, because, the sector, a lot of people say or think that it is fairly valued. It is not. We calculate the intrinsic value of the natural resources on a, mid-cycle basis for commodities, for returns, for margins. Our intrinsic value is 208 euros per share, and the fund is now 140 because we had a couple of bad weeks in the past 2 weeks. The IRR is around 14%, and it is well below intrinsic value. And this business, high volatility, high beta, very much short-term macro-related. And I'm adding here an illustration of the pendulum calculation. We think that, this fund was trading at 50 euros in the panic of March 2020. This means, 150 euros discount to intrinsic value. Amazing 150 euros discount to the intrinsic value, which is mid-cycle. So when the market understands the new super cycle, we think there is a lot of upside. But this is the same figure we get with the IRR in a few years. So in 5 to 6 years, this fund should be trading above 300 if our scenario is correct of higher energy prices and higher green metals prices as the main basis. Just a couple of comments on the main 2 markets we are invested in slide 29. So a lot of people think that demand of oil is going down. If you look at the last estimates from Woodmac, oil demand is going up after the COVID, obviously, catching up the COVID effect, and also because GDP growth is still globally around 3%. So we will see demand going up 2 million or more, 22, 23, and 24. Here, why prices are down. Maybe if you want to have more details in the Q&A, we can enter in details. But it's basically surprising production from Iran, Russia, and the reserve releases. But anyway, inventories are flat year to date. So there's no really reason to see lower prices. It's more a financial bet that we are going to go to recession and China is going to collapse. So this is very important short term for the oil price. But long term, in the end, you have depletion. We lose 4 million barrels a day every year. So we need a new Saudi Arabia every 3 years. Demand keeps going up. And in our numbers, it will go up for at least 15 years more. And then there's no investment. Nobody's investing in oil since 2013. So it's nothing new. Since 2013, investments have been very depressed. It's very difficult to invest here on ESG, CO2 emissions, and on fear of peak demand, because a lot of people think that as demand will go down, we shouldn't invest in oil because it's a long-term play. So again, long-term, we think that the incentive price the spot price has to move up to an incentive level to incentivize new supply. And we set this price 125 to 150, and we think not very long from now. Moving to copper in slide 30, this is even more obvious. You can track the mines that are coming to the market, and the new mines, we have identified mines until 2025. So supply demand will be more or less balanced until 2025. And then there's a huge scarcity in new projects. Very difficult to bring new projects to the party. ESG, licenses, local communities, taxes, political issues. All these mines are basically in South America, in Africa, or in complicated geographies. So it's really difficult to invest, 5 to 10 billion in a mine with a 10% return in a country where you don't control the general framework. So again, copper market, more or less balanced for a couple of years, but then a huge gap arises. And Woodmac has set this gap in 30%, 30% of the demand by 2033 in 10 years' time. We need to build mines now to have this supply ready for 2033, and this is not happening. Finally, a word on salmon. It's a bit complicated, so I can leave it to the Q&A, but basically the new resource tax affected the sector. The sector went down in the market by 35%. We did our numbers. We started to buy last year. Now it's a big position in the Classic, and negotiations continue. The last proposal is a tax of 25% from the initial proposal of 40%, so it's already good. But the Conservative Party is opposing that. So in the end, we'll see what happens with the taxes, but the sector looks very good. Taxes are going to be more balanced, and then you know, there's a scarcity of supply because you know, supply is growing 2, 3, 4% per year, and demand is much bigger. So it looks that the sector is back to a very interesting level after the negotiations on taxes. So it's a kind of 12% of the Classic already. Before the tax cut, it was 3%, 2%. So we were lucky this time. Final conclusion, very fast. I don't want to bore you to death. So commodity prices have been weak. The fund is kind of stable at this level, 140, 150. Short term, everybody is very worried about China, the US recession, and blah, blah. So this is why copper and oil and gas are going down, but nothing has changed. So what we will do is increase our positions, and if we go down more, we will increase more, and then the intrinsic value in the IRR of the fund will go up. Valuation is cheap, so still the fund is below mid-cycle. And just to highlight that this cycle will be much longer than many people think. It's going to be, you know, many years because of the energy transition. So, you know, we are very optimistic on that. This is why also we are invested in the Classic in the natural resources space. So with that, I think I hand over to Urs, that is going to dig a little bit deeper on the natural resources space.
Thank you, Marcos. I have here a chart of the global liquidity, which I think is M2. And, you know, if people want to draw a conclusion from liquidity on a global scale, then obviously you should look at liquidity on a global scale. And you saw that the tightness peaked in autumn, and since then global liquidity is already very good again. It first started with China, emerging markets, and since this banking saga started, even the liquidity in the Western world started to increase again. By the way, many markets also saw their lows in autumn. So if you're drawing a conclusion for global products like commodities, maybe one should also look at the global monetary situation. By the way, historically, it just grew every year 1.5%, despite recession or not. And what's also happening is, maybe on the next slide, Alex, this is a slide we already showed in autumn again. This is the copper market, where there is a future. You have to register yourself if you're trading in futures, if you're a commercial or a speculant. And you see the same as in autumn again, that markets have a maximum position on the short side from financial speculation, meaning obviously in anticipation of this slowdown and recession. The same is in oil, and you can look historically what happened when you had such a positioning. Market did the opposite, and what it a bit philosophically means that companies like Glencore can source copper cheaper in the financial market than in the physical market. That's why the speculants are always wrong if you have such big positions on the extreme side. And what happens as well in the industry in anticipation of recession, which is obviously not just the financial industry looking at, but the whole supply chain is reducing inventory. So that's, I call it a bit the toilet paper effect. You know, when you have anticipation of higher sales, then you stock up inventories through the whole chain. And if you have anticipation of declining sales, you first using up inventories. And that meaning that is people are mixing up. If, for example, copper imports in China are low, it doesn't mean that the copper is not being used. Obviously, if you have 4.5% GDP growth, I mean, this might be below some estimates, but at the end, it means you consume 4.5% more of everything. So this is quite a big number, you know, if you have 4% bigger consumption of goods and so. So we see it's a very good buying opportunity again, as the financial industry is so extremely negative positioned. And maybe the next slide, Alex. You know, it's also, which is also a bit typical. You will see this in an inflationary cycle now, that the velocity of money is now picking up the first time. This has some reasons, like Carlos explained, that people are confident they are not losing jobs, but maybe also they realize, even if it's not, or just by coincidence, but it's not worth saving anymore. So they just spend the money. And if you look at the last big inflationary cycles in the 70s, you know, then it was not such a good thing to hold cash. So you should hold assets, particularly real assets, value. Gold would have been something which is good. And we see some similarities. Just some anecdotes from Alex and my trips through the whole of Europe. And we have a lot of presentation, and it struck me, obviously we are the only special strange guys which are talking about value and commodities, but most of the people hold cash and talk about some back-tested long-short funds to avoid drawdowns with back-tested artificial intelligence things. And the other things what we also hear is only the interesting themes, like hydrogen, particularly battery and so on. But I come to that later. Maybe on the next slide, Alex. This is still the same thing. You know, we have still the same situation, that these natural resources are still very low in comparison to stocks. Nothing really has changed here, despite prices. By the way, I must contradict a bit Marcos and say, okay, the commodity prices are weak. I mean, commodity prices are weaker than they have been at the top. But if you look at, you know, the average of the last 10 years, commodity prices are not so bad. So obviously oil prices above 70 is worse than above 100. But, you know, the companies are making a lot of money, and you see, you know, the results and the dividends. So I think the industry trading on 4 times EV/EBITDA, 3 times EV/EBITDA, you know, is doing pretty well with actual prices. And big oil companies, even like Chevron, is buying back a quarter of all shares per year. So meaning with such high cash distributions on these prices, this company virtually buy back themselves completely in 4 or 5 years. Maybe the next slide, Alex. I come to this again, maybe talking about hydrogen. You know, this is this story about energy transition, etc. And I have the title, Getting Drunk on Chateau Pétrus, which is probably a good thing. I never did it, but unfortunately only 60 people can drink a bottle of Chateau Pétrus a day. So meaning, if you make this calculation of energy transition, you also have to look at, you know, what is really the availability of various things. And maybe on the next slide, Alex, I just found a good slide which shows a bit the size of various metals. For example, coal would be 3 times higher than iron ore. Coal is not a metal. And obviously oil would even be much, much bigger. So you can imagine what now happens. And even if you would believe in this Tesla story, I think in the whole cycle, the whole chain of this energy transition, whatever, I think you consume every element what is being produced and will be produced. And now if you start diverting due to the financial industry and the stories, and in a normal world, you would say the capex has to go to all these things in relation to the size, because everything is needed. You know, as Marcus said, the oil consumption is at the peak. There's never been so much coal burned as today. And now the financial industry starts allocating the capital not in relation to the size of the business. And you can imagine what happens if you take the capex, which you would have needed to do, let's say in oil, in energy, because it's 80% of energy production is by steam, and you allocating this capital in lithium, for example. You know, this has a huge, huge effect, that a lot of this money goes into just one little tiny thing, which nobody uses, at least not to the degree as it is, because you don't drive the whole Tesla story just with lithium. You know, you have to produce energy and everything. So we see a huge, huge misallocation of capital. And maybe on the next slide, this is also something you can check out. This is the abundance of elements. and there's a reason why iron, for example, has such a big production. Now, of course, it's not just the abundance, it's also the occurrence in concentration, but you cannot change something which is available to something which is not available, because it's just not occurring in the same size. And maybe I have to say a few words about this hydrogen story. You know, everybody was talking about hydrogen. It's the most abundant element in the world, but unfortunately it occurs together with water, animal, plants, and human. So I don't know how you extract hydrogen from human beings, and I don't want to find out, but the real production of hydrogen is by steam and methane reforming or electrolysis, splitting water. So hydrogen is virtually produced with natural gas, stranded natural gas. And if you look at the biggest hydrogen producers, in 10 years, it's estimated 20% of all exports are coming from Gazprom. The biggest hydrogen producers are Nutrien, Canadian Natural Resources, Shell, the Qatari energy company, Saudi Aramco, and so on, Linde and Air Liquide. So if you really want to invest in hydrogen, you have to buy such fund as ours, because these are really the companies that are producing hydrogen and not some strange concepts. And you can even buy them at 4 times or 3 times EV/EBITDA. And by the way, the most promising technology in hydrogen is gasification of coal. And then you can, in the same process, capture the CO2 and inject it into the old empty oil fields. So even if you want to do something for ESG, talking about carbon or CO2 capturing, you end up with the big oil companies and gas companies. Maybe the next slide, Alex. And this is, for example, this lithium chart. A few years, or maybe not a few years, but some time ago, you saw the same in cobalt. What happens when you make these stories? A lot of investments go into one sector, and you have a huge amount of overinvestment, and then you have speculation, the price goes up, and in anticipation of that, huge above ground inventories are being built. And then somewhere there's too much lithium on the world, and then you see something happening like this. And this will take time, a few years, until most of this promising lithium project will disappear. And this has nothing to do with the consumption. The consumption grows probably 1.5%, which is real GDP. But we always tend to tell people that one has to look at this investment cycle and capex cycle. And lithium is one of the few commodities which has seen a huge overinvestment in projects due to the obvious story. And whenever we are in Germany, for example, and hear these people talking, the only commodity they have an investment is usually lithium, which is absolutely nothing. You know, this is very small. Nobody is really interested in the world in lithium in terms of size of the business. Maybe the next slide, Alex. Then I just want to go quickly about these stories. This is a cycle of mine, and you know, we're talking about 50 years and the real harvesting period when you really have the production coming, and obviously the cash flows is very short in the whole cycle of a mine. And this is the reason why, according to our experience, as Marcus said, we want to be as close to the production as possible, because there is the cash flow. And obviously the risk is already high there, but if you're 50 years away from production, you can imagine what that means for your pockets, because you have to spend money every year to the CEO and the investor relation and some drill holes. Maybe the next slide, Alex. This is a very simple graph of an ore body. You know, everybody talks about reserves and resources and stuff like that. So the only producible thing is reserves, because they are the only thing in the ground which are producible in an economic way. And obviously the rest is never being produced. And in a commodity cycle, you have cost inflation, capex inflation. So historically, around 1 of 500 ore bodies goes into production ever. So meaning the rest is virtually worthless, because it's never going to be feasible to produce. And maybe on the next slide, Alex, I just have a little example. Maybe I showed this already, but you know, this story, like uranium is a good story, we know why and so, but at the end, you have to make money by producing something. And you can imagine when the historical uranium deposit has been produced with grade below 0.01. Of course, it's a big open pit mines in Africa, and Cameco has 2 mines which are complicated underground mines. Cigar Lake is the example here. It's below a lake. That's why it's called Cigar Lake. But you know, they mine 15% grade. 15. That's 150 kilogram per tons. And 2 companies produce 50% of all the supply. That's like in OPEC, in oil would be the whole OPEC, Russia, and the US. And even these mines were not really profitable with uranium prices of 20. So I just want to tell people, how would you have even an intention of spending your time and money for some absolutely ridiculous, marginal, stupid deposits, which are never going to produce and never going to make money, if you can buy these treasures and so. And this is a bit, you know, this has nothing to do with the uranium story. Of course, when there is a good story and then there are some market commenters say, okay, you have to buy uranium share, and somebody says, I have uranium in the ground. Fine, but you have to buy the companies, in our opinion, who are really producing it and have the good deposits. And that's a bit to trying to show our strategy. And maybe I've shown this again. So just a good story or a good movie. This is the example of the development of Freeport's Grossberg mine. And I advise everybody to go onto this link and just look at the film and the video, and it shows a bit how complicated it really is to bring this kind of assets into production. And we're talking about, 50, 60 years ago, when it's not such a complicated world in relation to, legal and ESG, etc. So you can imagine how complicated this is. And we would need every year such a new mine only to keep production stable, not talking about energy transition, more copper. So I think it shows quite clearly that we're going to have a problem. And I don't know how people can believe that there is going to be copper without any investments in mine. So it's a bit difficult. So that's from my side, Alex.
Thanks a lot, Urs. By the way, all of you will receive the presentation where we then can click on this link, which I strongly advise you to do so. Now we have already 49 minutes done, so let me just finish. What we see here is basically the classic since inception relative to all registered fund global equities in Germany. So we are really doing fine. If you look at Bloomberg over 3 years, we are on the 98th percentile. The net resources fund as well is on the 96th, 97th percentile over 3 years. Here we show the performance. What you clearly see is actually an underperformance in moment of stress. But then, of course, on the long run, if we really get to this next very interesting commodity cycle that is ahead of us, we should be a very good Lego stone to actually match your interest, to provide you basically a product that covers most of the net resources space. Now, it's time to chat us some questions. We already have received a chat question on the Grifols. They actually bought Biotest, and the question was, Grifols and Biotest are both good companies. Would it really make sense, or does it really make sense that they go together? Marcus, I think that would be a question for you.
Yeah, thanks, Alex. Yeah, well, let's start with that. Grifols is one of the biggest positions we have. Now we have around 6% of the classic in Grifols. We know the company for many, many, many years. We think the business is good, but they had a problem with management and the family-owned conflict of interest between the family and the management. They were too aggressive at acquiring companies in the past few years, so they geared the balance sheet, and then they had trouble cyclically from the cycle in COVID because they couldn't get enough plasma or blood, and this plasma was too expensive. So we had a kind of very bad outcome in the past 2 years. The stock is down, I don't know, around 65%, 70% from the peak, and we've been buying for the last years. In terms of Biomed, we think that the business of Biomed is a good business. Is similar to Grifols, plasma proteins. and margins are lower, so they need probably some scale in order to improve these margins. And then they have a very interesting pipeline of proteins. They are bringing to the basket of Grifols 2 new proteins that Grifols doesn't have. So, you know, the thesis for Grifols is we are going to restructure a little bit the company to improve the margins. By the way, Grifols is also restructuring itself. So there's a big restructuring process ongoing, both Grifols and Biomed. With that, they think they can increase margins. And then what they plan is to bring these new proteins to their basket. So adding the global scale, they will sell higher margins and higher volumes. So in this aspect, the management is very bullish. Problem is the COVID impact was negative short term. Second, they paid, I think, around 1 billion EV, which is a lot, and they geared the balance sheet, and now they need to de-gear. And then the performance of Biomed short term has been a little bit disappointing, both in the margins and in the pipeline, because approvals have been slower than expected. So net, still a big question mark. We are positive, the management is positive, but they need to confirm that. So we'll see in the next few years.
Thanks a lot, Marcos. I have received another question by email for Carlos. I mean, Carlos, you're actually describing in your books clearly in strategic logic what are actually good businesses. The question is, how comes do we end up buying natural resources company?
Well, they are not necessarily bad business. I mean, obviously, a silly definition. I mean, a platitude is that a good business is one that makes money over time. Now, many natural resources companies do not make money over time. Some do. Funnily enough, the reason most of them do not make much money over time is not that the business itself is too bad, is that managers are very bad. Now, managers tend to be bad in most industries, but they're particularly bad in industries where all you need is follow the cycle. I mean, if you're an oil company and oil goes to 130, you make money. You can be the worst manager in the world. And if oil is at 24, you will not make money. So they tend to be like most of us, but extremely so pro-cyclical. So when the business is doing well, they make a lot of money and they all invest in extra capacity, which takes a long time. That's why the cycle, that's why they keep making money for a long time. But then eventually all that extra capacity destroys their profitability for a long time too. So they lose money for the next. Now, if you take practically any natural resource company, the large ones, BHP, Rio Tinto, and you look at their big purchases, more than half of them, in some cases, almost all of them, are done at the peak. I mean, Rio Tinto buys an aluminum company for I don't know how many billions. Just 2 years later, they have to write off the whole thing. BHP bought like 25 billion worth of shale oil just before shale was collapsing. And they do that systematically. So that doesn't mean the business is bad. That means that many of the managers are not very good. So we invest in those natural resources companies where the commodity cycle, we understand it. Urs was mentioning lithium. Lithium does not have a good cycle behind it for an investor. It's very easy to produce. There's plenty of it. Now you can have a given moment where there is even scarcity, not just speculation, scarcity. Everybody wants lithium and there is no lithium around. But sure enough, in a year's time, there's much more lithium than you know what to do with. So we don't invest in those things. But in businesses with long lead times, like most mining in companies or minerals and certainly energy, if you know what the cycle is doing, if you know, as Marcos was mentioning, that there are no mines coming, and that the demand for the underlying commodity is not going to change. In fact, it is increasing. Well, you know we're going to make money. And Marcos likes to quote Warren Buffett. I will do it for once. Invest in monies that can be run by monkeys because they eventually will. Okay. That would be my answer.
Carlos, I think that's a very nice closing remark. I think we close here. We are already 55 minutes in the call. Thanks. Hang on a second. There is a question coming in. Many thanks to you all. Okay, thanks a lot, Markus Amstutz. Okay, thanks everybody. Please get in contact with us if you have any further questions. And yeah, I will send you the recorded thing with the link that you can click so you can watch actually this very nice video. Have a great rest of the week and take care. See you. Bye-bye.